Hi and welcome back to the channel, hope you're doing well. Today's video I'll be highlighting 3 UK stocks which I think look like good buys. These are quite obscure picks, so just disclosing that from the get-go. I'll be touching on each of the company's business model, performance and future growth. If you do like the look of any of these companies, please do your own research to make your own decision. Stock number 1 is a company called Volex, who manufacture and supply power products and cable assemblies in North America, Europe and Asia. These types of products are household appliances, laptops, PCs, tablets, printers, televisions, game consoles and electric vehicles. The company also provides solutions for data centre infrastructure, including data centre power cables and cords used within racks. Over the past year, the share price has been pretty range bound, floating between £2.30 and £3.20 a share, where it right now sits at around £2.50. This provides a market cap of 400 million, a PE ratio of 17.55 and a dividend yielding about 1.3%. Zooming out, and this company has had some fantastic performance with a 5-year return of 235%, and that's after coming down from a high of nearly £5 per share in 2021. This is a growing company with revenue being quoted in dollars, showing consecutive years of growth from over $350 million in revenue in 2019 to revenue of over $600 million in 2022. Earnings have also been growing, although looking at 2022 earnings they have come down slightly from 2021. Using simply Wall Street, it shows that analysts are optimistic about top line growth out to at least 2025, where revenue should be over $800 million, with earnings of $43 million. Looking into the balance sheet, short-term assets of $307 million outweigh short-term liabilities of $172 million, with short-term assets of $210 million outweighing short-term liabilities of $143.8 million. As earnings have grown, so has equity and debt within Volex. Equity has been grown to around $200 million and debt of $115 million, giving a debt to equity ratio of 57%, with a current cash position of $23 million. Using the financial health checker, it provides a 3 out of 6 score, with the main issue being that debt level is rising and debt coverage. And when we display this on the balance sheet screener, it's the debt which has of course been the cause for concern. Volex's November update was pretty positive. Organic revenue had grown at 14.3%, delivering total revenue of $357.5 million, including $35 million in acquisitions. Operating profit for the 26 weeks ended 2nd of October were ahead 17.6% year on year at $32.1 million, underpinned by robust customer demand and proactive management of inflationary cost increases. Its underlying operating margin stood at 9%. Volex recently acquired Review Display Systems Group in the UK for an initial consideration of $6 million, which it said would enhance its capabilities and accelerate growth in the market. Integration and transition plans for the recent acquisitions were progressing well, as the board also described good progress towards its 5-year growth plan, supported by a continued customer-led investment programme. A benefit of owning this company is that you get paid a dividend. Although it's not a massive one, it is well covered. Volex pay out twice throughout the year, with an interim being announced in December and a final dividend in August. It's been pretty consistent over the last 3 years, with a dividend of around 4 cents for the year. Volex has a good blend of products which are needed in everyday life, but also participating in high growth areas such as EVs, and while it's still in its early innings, if you're a believer that every house will one day have a charging point at home, then Volex will be a beneficiary of this trend. The consumer electrical divisions has growth in the uptake of smart appliances. The medical area of the business has growth due to advances in medtech, and finally the complex industrial technology element will have exposure to factory automation and the adoption of cloud technology. Year-over-year growth in the electrical vehicles between the first half of 2022 versus the first half of 2023 has eye-watering growth of 53% from $45 to $69 million. New products in consumer electrical showed good growth of 8% from $127 million to $138 million. Medical revenue had growth of 8% from $62 to $67 million, with complex industrial technology showing really strong growth of 44% from $58 to $83 million. Volex do have a 5-year plan in which they aim to be generating around $1.2 billion in revenue, with a steady operating margin of between 9 to 10%, with around $200 million of revenue coming from acquisitions. They expect that the EV sector will grow at a combined annual growth rate of 19%, with the complex industrial technology sector growing at 10%. Consumer electricals and medical are expected to grow around 4 to 5%. Tipranks only has one analyst on this one, who currently has a price target of about £3.65 per share, which would give you a 40% gain if this was to be accurate. Stock number 2 is a company called Triplepoint Social Housing REIT, who are a closed-end investment company. The company's investment objective is to provide shareholders with stable, long-term inflation-linked income from a portfolio of social housing assets in the UK, focusing on homes in the supported housing sector which have been adapted for vulnerable people with care and support needs. On a year-on-year basis, this share chart looks pretty terrible as it has fallen from close to £1 per share to now around 50p per share, so almost cut in half. This is a market cap of 200 million, a PE ratio of under 5, which by being a REIT isn't a fair way to value companies, and it offers a super high dividend of over 13%. Looking at this REIT's 5-year history, it has been another one which has been pretty range bound, but only in the last few months has the bottom fallen out of this and it's currently in free fall. However, both revenue and earnings have been growing in a consistent manner, with earnings of 20 million in 2018 to earnings of 28 million in 2021. This isn't a get rich quick company, as it doesn't have the eye-watering growth, but rather a steady eddy company that should have growing earnings over time. Simply Wall Street has expectations that earnings may have a slight dip this year, but top line revenue is expected to follow the uptrend that it's been on. REITs will never flag up in most screeners as being a good investment, as it always highlights the debt. Debt is important to REITs as it's how they finance their developments, and usually isn't a cause for concern as long as you can see that assets are continuing to grow. We currently have short-term assets of 45 million, which outweigh short-term liabilities of 4 million, as well as long-term assets of 670 million, outweighing long-term liabilities of 662 million. Equity and debt has been rising together, but recently this has been getting a little bit closer, and with the higher interest rate environment, debt levels could very well continue to get a little bit closer, with the combination that property valuations are likely to come down. We have a debt to equity ratio here of 58%, and cash on hand of around 40 million. And as mentioned, the debt levels are showing up in the balance screener as you would expect. Triplepoint Social Housing follow the quarterly dividend payment, but it's more common with the US companies. Payments are in March, June, September and December. So far for this financial year, there's been 3 payments which have been 1.365 pence per quarter. Looking to the yearly amounts, this has been slowly growing from 5 pence to 5.20 pence per share. This industry does have some headwinds, as Jeremy Hunt has capped social housing rent increases to 7%, where beforehand landlords would have been permitted to increase rents by the CPI rate plus 1%, which would have allowed a maximum increase of 11.8%, and that's likely the cause why you've seen this share price plummet. These are the latest results which we have available, and they are a little outdated as it covers the period ending June 30th, 2022. EPRA NTA per share, which is the value of assets minus its liabilities, is 111.80 pence, up from 108.27 pence. The target dividend is 5.46 pence, up from 5.20. The look-through dividend cover is 1 times. Group loan to value is 36.8%, down from 37.6%. Portfolio valuation of 669.6 is up from 642 million. Rent collection of 96.1% is down from 99.8% in full year 21, with the weighted average unexpired lease term of 25.9 years, down from 26.2 years. EPRA net initial yield is 5.28%, up from 5.2%. Since the company's IPO around 2016, the net asset value has grown from 98 pence per share to 111.80 pence to June 2022, with a stable growth trend between the timeframes. The total dividend being paid has accumulated in the same period, whereas as of June 2022, it has issued total dividends of 22.84 pence. This company has total rent collection since IPO of 99.3%, a cumulative total accounting return since IPO of 37.4%, and an annualised total accounting return of 7.6%. Running through some of the financials, rental income was up 14.3% for the 6-month period up to June 30 the year prior. Total expenses were up 12.9%. Gross profit was up 11.8%. Changes in the value of the properties report a massive jump in 2,192%. Operating profit was up 134%. Net cost was up 123.2%. Net profit up 137.7%, as was earnings per share, with the EPRA earnings per share up 6.4%. I've mentioned that there are some operational themes, which are that utilities, maintenance and staffing costs are increasing. There is a proposed cap on rent increases which has come to fruition, as well as rent collection which is currently at 96.1%. The outlook provided mentions that it will deploy remaining capital into good homes with a focus on additionality, supporting approved providers as they navigate the current inflationary challenges, forming partnerships with new approved providers using lease structures, and delivering their retrofit programme to ensure the portfolio's long-term sustainability. I can't deny that there is a lot of issues facing the overall home building space due to tight financial policies, but this extract from kingsfund.org forecasts that the number of older people and those with long-term conditions, learning disabilities and mental health conditions will increase. Estimates are that at least 1.7 million more adults will require social care over the next 15 years and would require the social care workforce to increase between 2.1 and 3.1 million. We don't have any price targets on this one as it's not available on TipRank. Finally, we have company number 3, which is Anexo. Anexo is a company that provides integrated credit hire and legal services. They provide replacement vehicles and associated legal services to the customer who's been involved in a non-fault accident. Its segments include credit hire, legal services, housing disrepair and Volkswagen class action. On a 1 year basis, the share price is down around 23% to a price of £1.14 per share. Currently has a market cap of 135 million, a really cheap PE ratio of 5.8 and a dividend currently offering 1.3%. On a 5 year basis, the price is pretty flat. It's come down to its COVID low and it's had a nice little bounce from that same level. The price has had a few peaks and troughs, but as of right now, it's almost at all-time lows. The share price is by no means correlating to the company's financial performance. Right now it is a bargain on a valuation perspective with a forward PE ratio of 6.3 and a price to sales ratio under 1. Again, this is in dollars, but revenue has been growing from 55 million in 2018 to doubling to 120 million in 2021. Earnings have been positive in all of these years, with 2021 being the best year so far for both revenue and earnings. Analysts expect in 2022 for revenue to dip, but as we enter into 2023 and 24, that revenue should return to growth and expectations by 24 that revenue will be around £142 million. Short-term assets of £211 million outweigh short-term liabilities of £63 million, with long-term assets of £19.25 million being outweighed by long-term liabilities of £29 million. That makes total sense that they have a heap of short-term assets, as this is a company who will be providing a fleet of vehicles out to customers, which will be reflected rightly so in the short-term assets. Both debt and equity has been growing, with a debt pile currently of 58 million, which gives Anexo a debt to equity ratio of 42.1%. Cash on hand currently sits at 1.25 million. The balance sheet screener has all green pass marks apart from debt being flagged up. Anexo's business model is pretty simple to understand and why I like it. The diagram shows that they deal with the non-fault motorist. It will likely be the case that this vehicle will have to go to the garage for repairs. At this time, Anexo issue their client a vehicle and through legal services are able to claim this money back. It's through this combination of credit hire and legal services, which appears to be a win-win. Using their latest results presentation, Anexo go into more detail on the services that they offer. The credit hire is pretty self-explanatory, but the legal services is likely where they will make most of their money through recovering costs of compensation from the at-fault motorist company. They have a housing disrepair division who deal with substandard housing, claiming for things such as damp and mould, as well as having an involvement in the emission cases such as with Volkswagen and Mercedes. The financial highlights for the first half of 2022 were really strong, with a revenue of 68.6 million, up 42% from 48.3 million, operating profit up 54.8%, profit before tax is up 52.8%, net assets is up 17%, cash collection up 19.8%, and basic earnings per share is up 52.5%. They have a growing fleet of vehicles, with the on-hire vehicles now at 1,947, up 11.9%. Completed vehicle hires are at 5,500, up 34.8%. Number of cases settled at 3,563 are up 21.9%. New cases funded of over 5,000 up 20.8%, with cash collected from settlement cases of almost 68 million up 20%. And to finish off, this is a company which offers a small dividend which is extremely well covered. They've kept it flat at 1.5 pence for the last 4 years, with an interim dividend usually around October and a final dividend around July. Again, we don't have any price targets on this one, and that will sum up this month's picks. I hope you've enjoyed the overview into each of these companies, and I'll catch you all in the next video. Thanks.